Well, that was a great book report, so I'm glad you're reading our research. Look, I think that it's pretty clear. The fire and ice narrative that we laid out back in September is what's happening. The ice portion has not happened, but the fire is happening. That was the crux of our call in September, and the crux of our year ahead outlook on November 15th was that inflation, which was running hot, and the Fed was going to have to respond to that, and that's exactly what's happening. So look, the key call for us is that valuations are just coming down. And we made that call back in March and April of this year. We said we call it the mid-cycle transition. There's going to be a rolling correction. And that's kind of what's happened. And we've navigated it really well under the surface. And the S&P has been very resilient. And that's what those comments were in October and November, was that we had strong seasonal strength. We had incredible retail flows. We suggested that we could rally into Thanksgiving, maybe a little beyond that. But that, as you approach 4,800, the risk reward was really poor. And I think that's sort of what's going on now. We're seeing, the real leadership names, the large cap names are now starting to kind of fall by the wayside, which is exactly what happened in 2018. The last time we had sort of that rolling correction idea, we called it the same thing back then. And it always ends the same way, Scott. It ends with, the bastions of safety finally taking a hit. So look, what are investors supposed to do right now? Well, first of all, they shouldn't be, risked up. Okay, the risk reward has not been particularly great since September. And that's the damage that's under the surface that Josh was, correctly citing. Small cap stocks, lower quality parts of the market, all the areas that we've been underweight have been underperforming. And the things that have been working is large cap quality. Now, what's changing today, I think, and this is something we've been talking about for the last couple of months, is that we're moving away from large cap quality growth to large cap quality defensive. Okay, and that's a big shift. And that's what we're seeing in the last week and a half or so. So what is the market? What is the market thinking now? Well, now we're talking about the ICE scenario, and that's something else we wrote about back in October. We said the ICE scenario has been put off, but it hasn't been eliminated, and that's going to be the slowdown that Josh was also referring to in the first and second quarter of next year, which is that we're going to get gobs of inventory now. Now we're going to get the supply is going to catch up. And I actually agree with Josh's comment. We're probably seeing a peak rate of change in the inflation measures. They're still going to be high, right? It's still going to be intolerable for the Fed, meaning 4% inflation is not a level they're comfortable with. So, but they're going to come down because supply is going to pick up. And the question I think we have to ask ourselves as investors now is that going to create an earnings problem for a lot of companies that people are not expecting earnings problems from? Because look what's happened. Companies have expedited supply. They've hired a bunch of labor at higher prices. And if there's excess supply now in the first or second quarter, potentially temporarily, that could lead to margin compression. So we'll see how that plays out. We're not sure about the ICE scenario yet, how icy it's going to get, but the fire part of our narrative is definitely in gear, and we're highly convicted in the multiples coming down, which is why we reiterated that in our year-ahead outlook on November 15th.
Sure, but if you suggested in September, which is 3 months ago already, that the ICE scenario is more likely of a 20% pullback, and we simply haven't had it. I mean, if you every time you're on continue to say we're going to have a correction, and then the next time we're going to have a correction, and then the next time we're going to have a correction, or your note suggests that, eventually you're going to be right. But that's not necessarily fair to investors.
Well, I mean, first of all, we said back in October that the correction wasn't going to happen, so we acknowledged that we were incorrect about that. Okay, we're big boys. We can face the fact that we're wrong. We're not right all the time. We get that. Okay, but the risk reward was poor. Okay, the risk reward has been very poor really since the middle of October, really early November, and we've navigated that well with our focus list. That's how we're adding value to clients. We're 300 basis points ahead of the S&P 500 with our focus list. And that's our job, is to be in the right places within the market, Scott. Okay. The index is just one part of what we're trying to do for clients. And what we're doing for clients is getting them in the right parts of the market, which is, exhibited by the performance of our focus list.
The other, I guess, I don't necessarily know if I want to call it an issue that I would have or want to discuss with you, is this notion of mid-cycle, and why you think we're in a mid-cycle rather than about to embark on a real early cycle, that we still haven't had the fruits of a full recovery. we still haven't been able to fully reopen, and here we are once again worried about the Omicron variant. And that once we can get past that, and that once we can rip the Band-Aid off and the Fed can taper and the market can go through the gyrations that it's going to go through, and then we can really have a boom, we have a real cycle. The boom that we never were really able to have. Why are you so convinced that's not the more likely scenario and we're in a mid-cycle, as you suggest?
Yeah, I mean, I think the chance of us being early cycle is virtually zero, just based on where the unemployment rate is, right? So, I mean, we're basically at 4.2% unemployment. So you can't credibly claim that we're early cycle when employment is almost at full employment. Now, maybe participation rate picks up and we can find some slack out there, but it's clearly mid. I would say there's a better chance that we're closer to late cycle than there is that we're an early cycle, just based on the metrics, on the economic metrics, which don't reflect early cycle behavior at all. I mean, that's my view.
So you expect the Fed to taper faster than the market expects, and thus to begin tightening much faster than we all expect as well? Is that the crux of your thesis moving ahead into 2022?
That's part of it. We don't expect to be faster, by the way. We're right in line with consensus on the tapering. The reason why we always thought that the tapering would be tightening for markets, if not the economy, is the following reason. They are going faster on this taper schedule than they did last time. Last time it took them 10 months to end QE. This time they're proposing, well, we don't know officially, but we think, and I think everybody agrees, that they're going to guide to 4.5 months to be done with this, QE program. That's much faster, okay? And that's going to have a negative impact on M2 growth, which is highly correlated to stock valuations. The second thing I would say is that valuation starting point is much higher today at 20 to 21 times forward versus 14 to 15 times back in 2013 and 14. And the third thing that's a change or different from that period is that growth is decelerating. Growth was accelerating in 13 and 14. So that makes the case for lower valuations pretty easy. And look, it's happening, Scott. I mean, you'd have to be, basically under a rock not to see that stocks are being derated significantly. All right. Now, I'll throw out a statistic here. 77% of the Russell 2000, okay, is down more than 20% from its highs. Mm-hmm. That's the max drawdown. 37% for the S&P 500 and 52% for the NASDAQ 100. Okay. That's the derating process. Valuations are coming down, and we just don't think it's over yet. But, it'll eventually be over, and then we can move forward. So and that doesn't mean you can't own anything either. It means you can own things that have earnings stability, that are going to deliver on the goods on earnings, and have reasonable valuations. And that's how we've been set up for the last 3 or 4 months in our focus list, and that's why it's outperforming.
Look, you have been dead right for many, many months about what you called, and I think we all have begun calling, and maybe in large part because of you, a rolling correction under the surface, right? And what you expected to happen was that a rolling correction would eventually hit the FANG stocks, and that was going to be the straw that broke the market. That would cause the correction to be more deeper than just, under the surface, all those stocks that were down 20% off of its highs. Did you get that part of it wrong? Are you surprised that the largest stocks in the NASDAQ have been able to carry the largest amount of weight and thus keep the market from having the magnitude of the correction that you were looking for? Because, look, only a couple of days ago, if not yesterday, we're talking about Apple nearing $3 trillion in market cap. You would have to believe that those would be the stocks that would have to do a full rollover if your ICE scenario would have been realized.
Absolutely. And that's where we admitted that we were dead wrong, right? The S&P did not have the 10 to 20% correction because, part of it was rotating around. So, the market did a good job of finding new things to buy. And those, 10 or 15 stocks have just been, incredibly resilient. And that's what we missed. Okay. So, we're wrong. We're wrong about that. And what we try to do is, make money in other ways, understand that call was wrong. And pointing out today that I don't think we're out of the woods on that because, the tapering situation may accelerate some derating, even in those highest quality areas that people have been hiding. We'll see how that goes. Do people need to worry about that so much? Not really. I think what people need to focus on is they make sure what they own in their portfolios aren't egregiously valued, and they can deliver on the earnings growth in the first half of next year when some of these, operational challenges, maybe get a little tougher. That's the focus right now.
I mean, I think it surprised a lot of people, the defensive nature and how powerful it is and has been for the Apples and the Microsofts and those kinds of stocks that haven't had the dramatic pullback, the likes of which some of those, high-flying price-to-sales stocks, those software names. So, I mean, what if that continues, that people just continue to find those as ports in a developing storm?
Absolutely. And look, those names are defensive. I mean, not all of them, but some of the names you mentioned have characteristics of being defensive and able to deliver earnings in any kind of an environment. And that's why they are so revered by the marketplace. But even within that group, in the last week and a half, some of those are starting to fall by the wayside. So, I'm not going to name names, but specifically, you can see it's even that group of stocks is getting narrower. So that's where we are. And how this plays out in the final innings of this derating process, I mean, that's why we tune in every day. We'll see how it goes. Right now, we're trying to focus in on where we think we can make money in a lower risk way, and that's how we're going to be set up until we feel like it's time to flip the other way.
Let me ask you finally before I let you go, and I'm looking at your targets for next year. Your base case is 4,400. That represents a 6% decline from where we are now. Not a terribly large degree of pullback, obviously. What gets to your bull case, though, of 5,000, which is a 7% increase? What has to fall in place for you to say we can hit that?
Yeah, we tried to address that in our note this week, Scott. We kind of went through the different scenarios because we do have a wide range of outcomes for next year. 3,900 is the bear case, 5,000 is the bull case. So it's you could drive a truck through that and drive 2 trucks. And so that the reason why we have such a wide range is because the economic and earnings outcomes we think is a very wide range of outcomes. We went through that as well. The bull case is Goldilocks. Okay, that is the bull case. And what that represents is that inflation comes down nicely, as Josh, sort of talked about, but it's not in a disorderly way, meaning it doesn't lead to margin compression. And the Fed can maybe back off a little bit on the pace of its rate hikes, if not the tapering schedule. And that allows multiples to remain elevated at 20 to 21 times. Okay, we don't, that's not our base case, but that is the bull case. And it's very possible. I mean, absolutely can happen. We can't tell the future.
Well, let me do this. Since you mentioned Josh, and it really feels like your bull case view is simpatico with the way he articulated his own view. Josh, you want to in on the conversation as well before we wrap it up? I'll introduce you to my